So I'm sitting in my office last Tuesday when my phone rings. It's Marcus, the realtor from Tampa, who closed 47 deals last year. Good money, right? Wrong. This guy is losing his mind because he just found out he's been throwing away $23,000 in tax savings every single year for the past 3 years. 23,000. That's almost 70 grand he's kissed goodbye because nobody told him about the QBI deduction. And here's the kicker. His accountant knew about it, but never mentioned it because it's, quote unquote, it's complicated. Look, I'm a loan guy. I help people buy buildings. I'm not a tax advisor, but when I see good people getting screwed over by myths and misinformation about one of the biggest tax breaks in history, I gotta speak up. So today, we're myth busting the qualified business income deduction. And if you're a realtor or investor who's been ignoring this, you need to pay attention because this could be the difference between building wealth and staying broke. Now, here's the cheat code most people don't know. The QBI deduction isn't some complicated Wall Street strategy. It's literally Congress saying, hey, if you're a business owner or an independent contractor, we're going to let you deduct up to 20% of your business income. 20%. But here's where it gets wild. Most realtors and investors have no idea they qualify, and the ones who do think it's too good to be true. Let me break this down like you're 5. You make $100,000 as a realtor. Instead of paying taxes on the full $100,000, you get to deduct $20,000. Boom. You're only paying taxes on $80,000. If you're in a 24% bracket, that's almost 5 grand back in your pocket every single year. But wait until you hear this one. Marcus thought he didn't qualify because he's an employee of a brokerage. Wrong, dead wrong. Real estate agents are typically treated as independent contractors for tax purposes, which means they absolutely qualify for QBI. His accountant was either lazy or didn't know the rules. Either way, it cost Marcus 70 grand. Now, don't scroll. This part could save you thousands. The biggest myth I hear is that QBI is only for business owners with employees and fancy LLCs. Complete garbage. If you're getting a 1099, you probably qualify for QBI. Realtors, mortgage brokers, property managers, even Uber drivers, they all qualify. The IRS doesn't care if you're a one-person show or running a 100% shop. Here's another myth that's costing people money. That rental real estate doesn't qualify. Wrong again. If you're actively managing your properties, doing repairs, dealing with tenants, you're running a business. That rental income can qualify for QBI. But here's the catch, and this is crucial. It has to be a trade or a business, not just passive income. This is where a lot of investors mess up. But let me tell you about Jenny. She owns 12 rental units in Phoenix, makes about $80,000 in rental income. Her old accountant treated everything as passive income, no QBI. But Jenny's not passive. She's screening tenants, she's coordinating repairs, she's managing the properties. That is a business. I found her a CPA who helped her restructure, and now she's saving almost $9,000 a year in taxes just from the QBI deduction alone. Now here's where people get confused. The income limits. Everyone thinks if you make too much, you're screwed. Not true again. The phase out doesn't start until you hit $413,000 if you're married filing jointly, or $206,000 if you're single. That's most of us, right? Even if you're above those limits, you might still qualify depending on your business type. Wait until you hear this one though. I had a guy call me last week. His name is David. He owns a property management company. Makes about $300,000 a year. He thought he was screwed because he heard QBI doesn't apply to service businesses. Wrong again. Property management can qualify as a non-service business if you're doing it right. David's now saving $21,000 a year in taxes, and the new CPA helped him understand those rules. The key is knowing the difference between specified service trades and non-specified service trades. Real estate brokerage, well, it's a service business, so there are income limits, but real estate development, property management, rental activities, those can be non-service businesses. The distinction matters because it affects how much you can deduct. Now here's a cheat code for investors. If you're doing short-term rentals like an Airbnb, that's almost always going to qualify as a business for QBI purposes. You are providing services. You're managing bookings, you're cleaning between guests. That's not passive income. That's actually active business income. And again, I'm not a CPA, but I've seen many investors save $15,000 to $20,000 a year just by properly categorizing their Airbnb income. You need to talk to your guy first. But Here's what kills me. People think they have to choose between taking the QBI deduction or other business deductions. That's not how it works. You can take your business expense and the QBI deduction. You're not leaving money on the table by maxing out your business deductions. In fact, business deductions can actually increase your QBI by reducing your taxable income. So let me break down a real example. Christina runs a real estate team in Austin. She makes $200,000 in commissions, has $50,000 in business expenses after expenses. She's got $150,000 in profit. Her QBI deduction is 20% of that, $30,000. So she's paying taxes on $120,000 instead of $200,000. That's saving her about $19,000 in taxes every year. Don't scroll, this part's gonna save you thousands. The biggest mistake I've seen is people trying to DIY this stuff. QBI has more moving parts than a Swiss watch. You got basis limitations, wage limitations, qualified property rules. It's not something you wanna mess up. The IRS is not gonna play games with this deduction. Now here's another myth that drives me crazy, that you need to have an LLC or a corporation to qualify. Wrong again. You can be a sole proprietor, filing a Schedule C, and still qualify for QBI. The business structure doesn't matter as much as the activity. Are you engaged in a trade or a business? Are you making a profit? Then you probably qualify. But here's where it gets tricky, and this is why you need good advice. The deduction phases out for service businesses above certain income limits. So if you're a realtor making $400,000, you might not get the full deduction. But there are strategies to work around this as well, like income averaging, business structure changes, timing of income. There are ways to maximize your QBI even if you're above the limits. Now, wait until you hear this. I know an investor, Mike, who owns a construction company and rental properties. His accountant was only applying QBI to the construction business. Well, it turns out his rental activities also qualified because he was doing substantial improvements in active management. So we helped him restructure, and now he's saving an additional $12,000 a year just from the rental QBI. Speaking of construction, this is huge for fix and flip investors. If you're buying, renovating, or selling properties, that's a business. The income qualifies for QBI. But here's the key. You need to be doing it with regularity and the intent to make a profit. One flip doesn't make a business, but 5 or 10 flips, well, that's definitely business income. Now, here's the reality check. QBI isn't permanent. That means we've got limited time to maximize this deduction. Every year you're not taking advantage of QBI, this money you're never going to get back. The biggest tragedy is when I meet investors who've been eligible for QBI for years but never claimed it. You can't go back and amend returns for 2018 forever. The statute of limitations is running out. If you think you missed out on QBI in a previous year, you need to talk to a professional tax person right now. All right, here's what I want you to do. If you're a realtor, or an investor, or a business owner who thinks you might be missing out on QBI, I'm hosting a special Zoom session this week, tomorrow actually, with Geraldine Serrano, a cost segregation specialist, and a CPA who specializes in QBI planning. We're going to walk through real scenarios, answer your questions, and show you exactly how to claim this deduction properly. The link's going to be in the description. These guys know their stuff, and they're going to break it down in plain English. Let me be clear. I am not your tax advisor. I'm not your CPA. I'm the loan guy who helps people buy buildings, but I see too many good people leaving money on the table because they're getting bad advice or no advice at all. The QBI deduction is real. It's substantial, and if you qualify, you need to be taking it. Don't be like Marcus, throwing away $23,000 a year because nobody told you about QBI. Don't be like the investors I meet who have been eligible for years but have never claimed it. The clock is ticking, and every year you wait is money that you're kissing goodbye. So if you're serious about building wealth through real estate, you need to understand QBI. It's not optional. It's not complicated. It's money in your pocket that you're already entitled to. The question is, are you going to take it, or are you going to let the government keep it? Here's my final challenge to you. If you made any business income last year as a realtor, investor, or entrepreneur, please call a qualified tax professional this week, not next month or next year. This week. Ask them about QBI. Ask them if you qualify. Ask them how much you could be saving. And if they can't give you a straight answer, please find someone who can. The link for the Zoom is in the description. Stop leaving money on the table, guys. Stop letting myths and misinformation cost you thousands. Your future self will thank you. And remember, the government's not going to call you up and tell you about deductions you're missing out on. That's on you. Make it count.